Dipan, very quickly, let's talk about pharma. Is there value, or you think that one should not, buy pharma stocks just because they've fallen down?
You have to be selective, I think, and I think there is value in the large cap pharma, but growth is very hazy and there is no visibility, and many challenges are there as far as US generic business is concerned, US FDA action is concerned. But there are some stocks selectively which can still deliver very decent returns to investors with usual disclosures that we and our clients are invested, like so say Biocon or Natco Pharma or Strides Arcolab for that matter. I think are slightly different in terms of the business model as compared to some of the big pharma companies like Dr. Reddy's, Sun Pharma, or even Lupin for that matter. So there is you have to pick and choose the right pharma stocks, but there are some pockets of stocks which could deliver good returns.
Dipan, what do you do with RBL, and how is it that you've taken cognizance of the earnings?
So I think the earnings are far better than street expectation, and clearly it's being driven by very aggressive management, dynamic management. They've been able to grow the business over the past several years and gain market share at the expense of not only just public sector banks but private sector banks as well. And markets have rewarded them in terms of higher price to book, higher price to earnings multiple. But difficult, to take a plunge at this point of time. It's easier if you already invested in RBL Bank. I think for those investors who are already in the stock, I think it's an easier decision. They should just remain invested. Clearly, this is a bank which is on a secular growth mode, and it's clearly following the path of its earlier peer group companies like say HDFC Bank or Yes Bank for that matter, or Kotak Bank, I think, which have delivered and are delivering a spectacular growth going forward. So I would say that it's a hold at this point of time. Certainly, just because valuations are high, investors may not book profits or liquidate their holdings. I think look for buying only at corrections.
Dipan, would you concur then with Sandeep Sabharwal here that A, HFCs are overowned, they've already run up, and then B, eventually down the line, because of competitive pressures, their margins are bound to get narrower as opposed to what they are currently at?
Yeah, but competition is not new for the housing finance companies, and they've been competing with banks for as long as they have been in existence, and they've managed the competition. And from time to time, some banks do try and do this predatory pricing to gain market share. But then I think the housing finance companies, the way they operate, the areas they are present in, the type of customers that they are servicing, they still are able to generate decent growth rates going forward. But the bigger problem as far as the investor is concerned is that there is only so much allocation in your portfolio that you can give to banks and NBFCs, and one needs to be a bit selective. I think if you the Nifty weightage is about 25-27% as far as banks and NBFCs are concerned, and there's just far too much choice over there. There's private sector banks, there is housing finance companies, microfinance companies, consumer finance, gold loans. So one needs to be a bit selective and not get completely overbought and have a large proportion of the portfolio in companies which are in banking or similar lines of business. So that's something one needs to be a bit careful about. So I think decent allocation in terms of sector-wise is important, and given that I think all these sort of choices available, housing finance maybe one of the sectors or the sub-segments where it could be slightly underweight, position more in terms of private sector banks, or maybe to an extent some of the gold loan companies or the consumer finance companies.
Dipan, would you advocate buying into two-wheelers at all right now, considering the under-ownership and the bleak fundamentals, at least currently?
Only one company with usual disclosure that we and our clients are invested, and that is Eicher Motors. I think another company which is matching the kind of returns and growth which Maruti has got, and although valuation is on the higher side, I think there's great opportunity as far as exports are concerned. And once the new plant goes on stream, you will see even better performance going forward. So clearly, I think if you're looking at buying into two-wheeler stocks, I would say don't go for the likes of Hero Honda, Bajaj, Hero Motocorp, or Bajaj. They are losing market share at the expense of the Eichers and Honda Motor as well as TVS. So I would say go with the companies which are gaining market share over there, which are able to sustain growth, and which are still able to look for volume as well as maintain their profitability because of say operating leverages or moving up the value chain. So that's basically the strategy as far as auto is concerned. Just go for the winners over there, which are gaining market share, which are seeing volume growth month on month, which have been able to make a success of their new models, I think that's where the action is, and market have recognized that and are certainly traded bid their P multiples higher. But even from these levels, over a longer term period, I think you will get better returns than some of the underperformers in the auto industry.
Dipan Mehta, let's get closing comments from you. If names like Page Industries, iShares, Bajaj Finance, these are the kind of names which have dominated Indian markets for next 2 or 3 years. Do you think they will dominate Indian markets for next 2 or 3 years, or fresh new names are likely to be the leaders now?
See, I think this market is chasing growth. Wherever there is growth, 15-20% type of top line, bottom line secular growth, those stocks are being re-rated higher and higher. Their P multiples, price to book, are expanding because more and more investors want a piece of that growth. Also, what you noticed is that the last 2-3 years or so, there has been more and more institutionalization of our capital markets. Retail investors are coming in through professional fund managers like mutual funds or portfolio managers, and these professional investors, they don't look at the actual digits, whether it's 3-digit, 4-digit. They are looking more in terms of what the valuation is and what the growth is, what the stock is looking good, what the performance of the company will be 2-3 years down the line, quality of the management, return on capital employed, many other qualitative and quantitative factors. So I would say that let's not get bogged down by what the price of the company, the stock price is, but let's get focused on growth, and that is where I think maximum action will be and highest returns will be. And there are very few companies, I think, which are able to deliver secular growth in India at this point of time. Sure, you will have a company or two, which delivers 2-3 good quarters, but then base effect catches up, or the cyclical starts playing in. Many challenges then tend to come up. So that's where I think investors could, have a bit of a trading position. But long-term investing has to be, you have to focus on growth over here. And as I said, there are very few companies, and if they are priced at higher P multiple or at a high valuation, then so be it.